This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Before this podcast became this wide-ranging kaleidoscope of different personalities, different disciplines, way back in the day, I pretty much wanted to start as a trend-following only podcast. That was the goal. That was what I set out to do. Now, along the way, and I've discussed this before on the podcast, I switched gears. I wanted to bring on a wider range of guests. And so far, I think I've done a pretty good job of that. But today, I want to reach back and I want to go to a trend-following, a quant mindset guest, Paul Britton of Apollo Systems Research Corporation. Paul and his firm go straight at momentum-based trading. One of their portfolios is trend following. One is more of a trend following on a very short-term basis. Always staying close to my roots, always keeping it with that certain quant mindset. But it's not just a quant mindset. It's a quant mindset around a certain type of philosophy. And Paul shares that philosophy. The philosophy is we can't predict anything. We don't know what the big winners are going to be. So when you get a big winner, ride it. Now, Paul uses a quantitative strategy to achieve that philosophy. But don't allow the word quant to confuse with the philosophy, to confuse with the strategy. Because without that strategy, and going back to David Ricardo, without that strategy of letting your winners run, cutting your losses short, Paul and I would not be having the conversation that we're about to have today. Without further delay, let me get right into that conversation with Paul Britton. Paul, take me back in time. When's the first moment that you had your aha that instead of mimicking Warren Buffett's strategy, instead of going down the path of knowing every piece of fundamental information to make a trading decision, what got you going down the path that a little momentum, a little price moving, a little volatility, what caused you to come over to that dark side of thinking?
Well, I'm going to take you back even further than that because I think it's kind of a funny story how I got interested in markets in general in the first place. I don't know if you're familiar with Ottawa. We're in Ottawa, Canada, but this was sort of a tech hub in 1990. Well, it still is a bit of a tech hub, but in 1999, Ottawa, and particularly Canada, the suburb that we're in, is referred to as Silicon Valley North. So there was a heck of a lot of technology stuff going on here. And of course, the stock market boom was in full force. So as a high school kid, everyone everywhere is talking about the stock market in town. And I ended up, through my dad, actually, who's interested in the stock market, but he put me onto this stock. And you probably heard of it, actually. You remember Covel Corporation? Covel Draw.
Covel Draw. Hey, by the way, what year are we talking, just for reference?
This would have been, I think, the summer of 1998 or 1999. I won't go too much into the details, but they got into the Linux space. And there was a brief stock market Linux craze right before the real full brunt of the dot-com hit. And I bought this stock in high school at $5. And before I could do anything, it was at 30 and I sold half. And then it went to 60. And I thought, well, you know, if 30 was a good sell point, then 60's got to be twice as good. So I sold the other half. And I thought to myself,
no plan here, just gut feel.
No plan whatsoever. And wouldn't you know it, sort of the worst thing that could happen to a newbie on their first trade, 60 happened to be more or less the top. So I thought, wow, I'm probably the smartest person that ever lived. I sold it right at the top and it was easy. And then to compound that, the next stock that I bought, I think went up twofold and I sold that. That one I got out way before the top, but put it back into another stock. And I had 3 in a row basically where I had a minimum of 100%. And I was, you know, a high school kid in class thinking that, you know, I'm never going to need to work. This is easy. I don't understand why everyone doesn't do this. And then the sort of the tech wreck hit Luckily, I didn't have very much money at all at the time, and I was largely unscathed, but I sort of could watch what was going on, particularly in our city. There was lots of layoffs and lots of vacant buildings and stuff as a result of that. And I recognized to my benefit that I was more or less ignorant about what I was doing, and I had been extremely lucky. So that gave me sort of the initial push to get interested in markets. And I started reading. My dad gave me a copy of Reminiscences of a Stock Operator. And I think from that, I sort of pulled out, he started talking about the big money is necessarily made in the big moves in that book. And I thought, there's got to be a way to do that kind of thing, to at least screen markets to tell where interesting stuff is happening. From that, I got a copy of Metastock and later a copy of Wealth Lab and just started working with data to see if I could make something work. And I started messing around with moving average strategies and very sort of rudimentary things at the outset. And lo and behold, some of them seem to work. And as soon as I got over the notion that your win percentage matters and what you're trying to maximize is your profit, not how often you're right, but the degree to which you're right when you are right, that's when it sort of clicked. And actually, you're going to like this. The missing piece was sort of the volatility-based position sizing. So sizing positions in proportion to the risk of that instrument was something that was missing and that I picked up in one of your courses. I was a customer in, I think, 2001 or 2002. And I thought, as soon as I read that piece, I remember I was skipping class in university in the library reading that material.
I did not pay for that endorsement.
Yeah, well, I bet you this is like over 15 years ago, right? I'm sure that you did not even know that was the case. But I remember reading that and thinking to myself, that's brilliant. I can't believe, I was kind of embarrassed that I didn't think of it because once you know that, it seems like such an obvious thing. But I came at it with, I guess, luck got me through the door and then piqued my curiosity, and the rest is history.
So let me keep you back in time a little bit and kind of get you to maybe explain a little bit more of your research process. Okay, you mentioned the books, you mentioned some information that came from my world, but I'm looking at your live track record. You're at about a decade of live trading, right? Yep. So that's a decent track record. I mean, back in the early 80s, you would have had a lot of the quote legendary trend following traders would have started in the 70s. So they would have had comparable track records. It's funny how that works. We forget. But tell me some of the other pieces that you might have pulled together. I mean, were there any individuals that you ended up looking up, so to speak? Were there any kind of mentors along the way? Because when I look at your track record, I mean, it's legit. I mean, it's the kind of numbers that I would expect to see. Now, there's two different things we're going to talk about today that I can look at your trend following portfolio, and those are the kinds of numbers I would expect to see. But then you've also got a newer strategy as well, too. I guess you might even say complementary or alternative strategy to your core strategy. But take me back to that time, though, that early time. Was there any other galvanizing force that set you down the right path?
We spent a lot of time reading everything that we could get our hands on about, in particular, trend trading, be it documents from managers or market wizards were a big help just in the conceptual realm, sort of trying to formulate the problems correctly. But to a large extent,
you were working internally and just kind of doing your own thing.
Yeah, to a large extent, we got market data and computers and started doing research to see what we could find. Of course, as you would expect, there was a lot of false starts and a lot of, we went down a lot of wrong paths. But one of the universal things that we discovered is sort of the momentum bias is present and it's really hard to break.
Define it for the audience, the momentum bias from your perspective.
I can't do better than the way that Ed Seykota states the essentials, basically ride your winners, cut your losers, and manage your risk and file the news. Basically, aligning yourself with the trend and riding the trend till the end seems to be something that is very robust. And it's really hard to break that. A lot of the work that we do here is related to trying to pick apart the pieces of a strategy.
When you say can't break it, you can't prove it wrong.
Yeah, and more than that, though, and I guess that's a good way to state it, but a lot of the work that we do is we'll take a strategy, for example, and then we'll replace the entry condition with a random number generator and take totally random trades to see whether the strategy still works. The exit and the risk management conditions still provide value. And as long as you're aligned with the trend, generally speaking, you can get a positive strategy under those circumstances. It doesn't really necessarily look all that great, but it's better than a losing proposition, which after cost and all that stuff, I think is saying quite a bit that there's really a long-term edge there. The flip side, of course, is that it's not always the easiest thing to sit through, but that's part of the game, I think.
When you describe letting your winners run, and which kind of forces us to think about a significant trend, either up or down in whatever market, I'm amazed, at least in my world of communicating with people, how many individuals, and I guess it's often newer people, they really can't wrap their arms around the big picture. And what they get caught up in is like, do I have the exact entry right? Whereas if you kind of play with this a little bit from a robust standpoint, once that trend takes off, I mean, this is what you're trying to find, and you kind of just said this in your way, a lot of different nuances are going to work, different kind of indicators are going to work. It often becomes consistency in the big picture. And the big picture is, are you trying to capture these big, unforeseen, not predictable moves?
Yeah. And to that end, we've sort of found that the entry condition, I don't want to say it doesn't matter, but it's of minimal importance compared to how you exit and how big of a retracement you're willing to withstand before you've determined that the trend is over. Those are the things that seem to really matter. But whether your entry signal is based on breakouts or moving averages, or you can be as creative as you like in that regard, we've found it's picking up the big trends and riding them and really pressing your luck when something starts to move is the thing that really delivers the value.
You probably recall this from your early research, looking at perhaps disclosure documents of established traders back in the day. I remember a lot of those disclosure documents that I would review, 70s, 80s, 90s. They would often, even the trend following traders, they would often say we were 95% systematic with 5% discretion. And then I would sit there and I'd crunch some numbers and I would look at all this field of trend following traders from, let's say, the 90s and 80s. And they'd all say, we've got this flare, this 5% flare or something like that. And then you kind of do these correlation tests to look at their performance, and I'm thinking, hold on, I'm not really sure I'm buying this all together. Perhaps. Now, you come out and you very loudly and proudly say, we are fully systematic, which a lot of traders do today, which a lot of traders do say that today. Give me your perspective, the fully systematic versus some folks that think they can be systematic and then also have some seat of the pants, discretionary something that's added in to make everything even better.
That's a tough one. We're fully systematic, and I'm a staunch believer in that it's really hard to consistently do better than the system. It's possible to do better on a one-off shot, but it's essentially random luck as to whether you do better or worse. But my view is sort of that you're systematic or you're not. And if, for example, you say you're 5% discretionary and your plan is to intervene when there's extreme events or something like that going on, then often those kind of market environments are total make or break periods, right? We just saw last week a reasonably big sell-off in the S&P. And if, for example, you were a vol seller in that period and your plan was to intervene with some risk management, if you'd done it incorrectly, if you doubled down at the wrong time or whatever, it could be a fund-ending endeavor. So the inability to sort of back test and robustness test and run scenario analysis on human decisions, particularly in times of stress, is something that I think prevents us from wanting to rely on a discretionary intervention in any sort of circumstances, but particularly in tough times.
By the way, I should ask about Canada. You mentioned Ottawa and whatnot. So all I know these days is that there is this terrible competitive trade war between America and Canada. And you guys are doing something really bad with milk, something to that effect. And there could be a war of some sort between the US and Canada. Am I mistaken, or is there's some truth to this? The war is starting soon, kind of like a new version of Red Dawn. Canadians are going to come down and there's going to be some kind of invasion of some sort. Is this accurate?
Well, the trade war stuff is accurate. There's a strong, I'm not even really exactly sure what's going on there. There's a strong dairy lobby in Canada, certainly, and the dairy board sort of controls all of that. And it looks like they've just made concessions through this new trade agreement. But of course, the government of Canada is going to make the dairy farmers whole on whatever they've given up. So it's not really sort of Canadians are eating that.
How much of this is relevant to your trading? Zero.
Oh, yeah, absolutely nothing. We do trade milk in the portfolio, and I was looking at it a little more closely just out of curiosity to see whether there was any sort of bump in it or anything, but the milk futures don't seem to even notice what's going on there.
If you were doing this the fundamental way, you would say, okay, let's discuss or let's input the current color of Trump's hair. I'm not saying Trump's a bad guy, but we look at the current color of Trump's hair, which seems to change, and all kinds of other factors to how much yogurt is being consumed in Canada versus how much milk is being spilled on the floor. All these other kind of factors, but you don't need to know those things. You don't need to know the current color of Trump's hair or how much milk is being spilled to accurately trade milk. And you really, I'm guessing, don't know a damn thing about milk.
No, my philosophy on that is that I might know a little bit out of strictly curiosity, but it's no more than that. The people who know the details of these businesses are, generally speaking, profit seeking and are going to know way, way more about the details than I can ever hope to know. And their views will be reflected in the price, basically. When they make their bet based on their views, that information shows up in the price, and that's what we respond to. We basically let them tell us what to do, let them use their superior knowledge and observe it via market pricing.
The one thing that I always think about this particular trading strategy, your world, my world, is what you just said. We condense it. We take it to a line. But I always say to myself, what percentage of the doctors, attorneys out there, college graduates, etc., what percentage of people truly have ever heard of what you just said? And number two, get it?
My impression, and maybe I'm biased because this seems to be a very cold space in Canada at the moment, and possibly it always has been, but my sense is that it's a very unpopular or poorly known method of doing things, like the simple heuristic method of making decisions. I was talking to a guy the other day who just didn't get it when I was trying to explain that prices are only input. And he was asking, I think he used Facebook as an example. I see Facebook is down 2% today. And how do you know how you're going to trade it? What do you know about Facebook that's going to give you the insight that you need to trade it? And I said, well, if down 2% is significant to our model, then we take the action dictated by the model. But it just didn't compute. And this was a reasonably sophisticated investor in another space, had no experience in systematic. But I'm always amazed that it's such a clear formalization of trading rules. I'm always amazed that it's not better understood and more popular. To me, it just makes perfect sense. And I don't really understand why more people don't do it this way.
I mean, I'm looking at your materials here, and you're at what? You're trading 110 different markets. And so here you are trading 110 different markets. You do not, and these markets are going to range from the milk that you mentioned to coffee, to sugar, to stocks, to currencies, to rates, etc. And here you are, not trying to be cocky or anything like that, but you don't have to have a fundamental expertise in these markets to trade them. Now that kind of builds on my point that people don't really get this, but you don't have to have a fundamental expertise. And I think it gets really back to the schooling system. I mean, the way perhaps business and economics are taught, this desire to try and find out a why of why something does something versus just accepting what it is and going with the real data.
Yeah, and the why is always apparent afterwards. I think that's one of the other complications, is that people have a really hard time making the decision if the why isn't available beforehand. And a lot of these times, particularly the really big moves, it only becomes apparent after the fact. There was a good case in one of the probably lesser traded markets, oats, a couple of years ago, where the price of oats spiked like crazy. And after the fact, it was revealed that the reason was that the railroads in Canada didn't want to give any rolling stock space to oats because the margins were too low. So you get these really weird things. And if you'd waited for that information, or if you'd relied on expertise in the oats space to give you that insight, you'd probably be, 6 months too late on that kind of thing.
And you get a chance to benefit from that market direction, from that market volatility, from that market movement. And you don't have to have anybody on staff that knows anything about oats except perhaps how to eat oatmeal.
Exactly. All we need a rigorous defense in case we're wrong. And we do that through position sizing and diversification. But we do need to consider the case. And, we're wrong slightly over 50% of the time. So that's our hedge against not having the fundamental expertise in any particular market, is that we're experts in cutting our losses, making optimal bets on future developments of trends.
So basically, to trade Swiss francs, the only information you really need to know is, well, price. But the fact that you can go use francs to buy something, or you can drink coffee, or you can eat oatmeal. I mean, these things that have great stories and look really fantastic, and we talk about it on the nightly news. And I think that actually brings up another point: the nightly news and the financial channels. They are the counterbalance to the logic and wisdom that you're throwing out today. And these financial programs, nonstop, 24/7, are saying the exact opposite of you.
Yeah, and in some sense, I think we'd like them to continue.
I don't think that they're never going to stop.
Yeah, well, exactly. But their business is providing entertainment to a large degree, I think. They have to fill their time slots with guests, and their guests have to make predictions about stuff. And, if you're employed as a currency analyst, of course, you're going to have a lot to say about currencies. But that's one of the things that I like to do, is to check back every once in a while and see how someone's recommendations panned out. Particularly right now, I'm having a good time looking at how people's Bitcoin predictions are panning out. And you can see that they're all over the map and no one really seems to have a clue. But if you'd had a trend system running in Bitcoin, it doesn't matter. You would have caught the move from 2,000 up to 20,000, and then probably, a reasonable system would have gotten you stopped out before the carnage occurred.
Yeah, I know plenty of young people in their 20s and 30s that I think they did the full up and down. And I think even worse is everyone got in with Bitcoin. And then I think the move, and it reminds me so much of the dot-com bubble, but the idea was to diversify into other coins. And I saw coins referred to the other day as a little crass, but shit coins. And so I think that diversification, probably even people that would have perhaps eventually got out of Bitcoin, they probably have lost an absolute bloody fortune by just diversifying into literal scams. But, even if it was a scam, if they had a trend following method, they could have saved their skin.
Like you said before, it doesn't require you to know even whether it's a scam or not. The circumstances you're never going to be able to protect yourself against are where the thing's trading at 100 one day and 0 the next, if it's that kind of scam. But that's why you have position sizing rules and diversification. So you're never exposed in too great a size to that kind of thing. But whether or not it's a scam isn't really relevant to the systematic trader, in the sense that you'll ride the fluctuations. And if it starts to go strongly against you, you're out, and it's someone else's problem in a sense.
We were talking about your trend following track record, the 10-year track record. But what really intrigued me in looking through some of your current materials is you have a new program that you're essentially launching just in the last few months.
Yes.
The thing that's really interesting to me is it looks like on paper, and correct me if I'm wrong, very different than your trend following strategy. And the biggest difference I can probably see, and I want you to kind of elaborate on this point, and then we'll kind of dig back in and to find out how you decided to go this direction. But the strategy, and I'm quoting from you, it's generating 350 trade events per month on average, with a typical holding period of 2 to 3 business days. Now, that's not high frequency. It's definitely not traditional trend following either. Tell me about this new strategy, how you started to go in this direction.
There's always been an interest in the shorter term stuff and in the technology side of this space. Maybe it'd be instructive if I give you a little bit of background about the family office here. So we have a background in, the founder comes from the space technology world, and our chief scientist is also a space guy. So combined, they have, I don't know how many things floating around in outer space right now, but various pieces of technology literally in outer space. So they're interested in the technology side and the pushing the limits of the trading stuff. And there's always been an interest in doing things a little bit higher frequency than the long-term trend following. So that's where the idea comes from, to move into the shorter term space. The strategy itself, it still has a momentum bias, and it generates a distribution of outcomes like you might expect from a trend strategy, in the sense that the average trade length is 2 to 3 days, but if we get a big winner, then we'll stick with it. And the big winners probably have an average holding period of more like 10 to 15 days. So you're getting into what I'd consider the short-term trend space. But the whole premise of the strategy is that there's self-similarity in markets, or markets are fractal, in that what happens at a really small time scale is ever so slightly indicative of what might happen at a slightly larger time scale. So we take that momentum bias, we take this self-similarity thing, and it allows us to tweak the position sizes in this strategy to bias towards markets that are slightly more favorable for the 2 to 3 day trends, and reduce weight or stop trading the markets where that kind of short-term trending behavior is not going to be present or is unlikely to be present according to our models. And the short-term trading combined with this sort of unique weighting methodology of markets seems to produce something that's uncorrelated to traditional trend following, to hedge funds, to stocks, and to bonds. So it's a pretty interesting program. It's in its infancy still, but we're excited about it.
Well, when I look at your simulated track record for this particular portfolio, this particular strategy right now, the one thing that I always look at, especially on the shorter term strategies, are we positive every month? And you don't show that, so there is clearly, as you mentioned, the trend following type bias, even at a shorter time frame, because there's definitely down months.
Oh, yeah. And the down months can be substantial. Like, the performance appears smooth from, 30,000 feet, but when you're living through it, once again, it feels a little bit bumpier than it looks, maybe is a good way to say it. And one of the things about this kind of strategy also is that because of the trading frequency that you mentioned, there's no way that you could do this manually. We trade about 70 markets and we're making about 350 trades a month. So we're a team of 5 with 2 guys on trading duty to the extent that operations or manual stuff is required. But you couldn't possibly do that level of trading activity with just 2 people. So yeah, automation is an absolute necessity in that case.
Let me take you back a step to something when we were talking about your trend following strategy. One thing that I've noticed in your world, and I want to know if things have changed in terms of the description, referring to yourself as a global macro strategy. Years back, if I heard global macro, I would have generally thought of a player that was not a trend following type player. I would have thought more of, even though global macro would always be an apt description for a globally diversified trend following trader, there was always typically this kind of divide. And the global macro was often the still position, maybe like a Paul Tudor Jones. And Paul Jones would really never come out and say he was a trend following trader, even if he might have been. But speak to me about the use of the term global macro.
We're doing it, I guess you could say, for the opposite reason that Paul Tudor Jones doesn't call himself a trend follower. In Canada, people are really not familiar with the managed futures or the CTA label to any degree, but global macro seems to get a little bit more traction. It's to tell people who are unfamiliar with the specific systematic trend following space at a really high level what we're about, which I think in that sense is an accurate description of our focus.
I agree. It's one of the few times I think I've seen a trend following trader say it, and I do like it because it's a lot more accurate than saying, and I'm going to be on my soapbox, which I've been on for a long time. It's a lot more accurate than saying managed futures or commodity trading advisor, which is just a residual brain fart from Chicago.
Yeah, it's one of the things that we end up having to explain to people is that despite the fact that we're a CTA, which stands for Commodity Trading Advisor, we trade a lot more than just commodities, and you have to make the distinction that currency future also falls in our basket. It's not just physical.
It's this crazy thing when you say Commodity Trading Advisor, it's like, okay, you put your feet in concrete, you let the concrete set, and then you start trying to give an explanation, and everybody looks confused, right? The fact that a trend following trader with the type of portfolio that you are trading, the fact that you could absolutely be pigeonholed by an investor or institutional investors or by the investing community at large, be pigeonholed by the word commodity in 2018, you have to wonder, are we all still sane?
Yeah, it's very strange. We just had a new guy come into the business within the last couple of months, and he's shocked by all the sort of the jargon in this industry, half of which, the term hedge fund, for example, doesn't make any sense
right.
in the sense that
you're not hedging anything.
Not much hedging. Yeah, there's not much hedging going on. It's 3x beta on the S&P or whatever in a lot of cases, but it's still called a hedge fund. And just to be clear about that, I'm using the term CTA in the generic sort of strategy classification sense, not in the formal registration sense, because we're not actually registered as a CTA at this point.
Well, to also take this jargon another step, I've noticed the academics have now gone for, okay, we had trend following, and that's the one that's actually generated all the alpha over the decades and decades and decades. But then the academics said, well, what about this cross-sectional momentum? Oh, hold on, we've got two forms of momentum. We have time series, trend following. We have cross-sectional relative strength. Even though there's really only been one of those strategies that's produced decades and decades of return, you're right, we just continually allow this space to get confusing.
Yeah, and to us, it's just what we say, but it resonates more with people. People seem to understand global macro. It gives it like a better high-level view than some of these very specific, very strange labels that have been forced upon the systematic guys, I think.
I had some people recently, and I really enjoy Jerry Parker's Twitter feed. Jerry's always pushing the trend following gospel. But I've had some people come at me recently and they say, well, what about this trend following? The performance is not very good. And of course, now look, there are some very successful traders that are managing such big mountains of cash we can't even count it anymore. But I always say to them, hey, hold on. Why don't you take a look at a track record? And I'm not going to mention your competitor right now, but there are some track records out there from somewhat smaller managers that go back 15, 20, 25 years. Well, in the case of one I'm thinking of, back 40 years, 40 plus years. And I always look at those as touchstones. And your track record's a nice touchstone too, even though it only goes back 10 years. But I look at those as touchstones and I say, hey, hold on. If you really want to make the case that trend following is, quote, dead, which is a case that's made every couple of years, what about these guys over here? Don't just tell me about the $100 billion fund that's reduced their leverage and reduced their volatility and all that kind of stuff. Let's stick with the tried and true, going back decades upon decades, original style trend following.
When you say 40-year track record, I'm pretty sure I know who you're talking about. And this is who we look to for inspiration, particularly when we're having a tough run or in a drawdown. I tend to seek out comments from guys like Jerry Parker and hear how he's thinking about the current conditions and so on. But yeah, I totally agree that these long-term track records are very instructive. And the fact that a guy like Dave Drews doesn't appear to be giving up, or some of these smaller but very long-term managers seem to be just chugging along, I find a lot of inspiration in that. And I think we're in an environment maybe right now where the Fed has sort of got their sponges out to soak up all the risk, but we'll probably enter conditions where trends are extremely prevalent compared to the last 20 years. And a large part of the challenge in this is to survive until the conditions get really good. So as long as we can survive the choppier conditions, then we'll be well positioned to exploit the good conditions.
What a defensive mindset that most people would never think of in terms of making money. You just said my goal really is to survive, to protect my downside, and to wait for, back to the beginning of our conversation, to wait for the unexpected huge trend and just follow our winners. Whereas so many people wake up and they say, hey, hold on. Tell me how you're going to walk into the market today and kill your dinner and how you're going to make money when you want to make money.
Loss of principle is the most damaging thing because it hurts your compounding. And in the long run, it's the compounding that's going to do all the heavy lifting for you, right? If you have 20% years back to back, that's where the big returns come from. Larry Hite says it best. I think he has his quote there about when you got to bet, and you can't bet if you don't have any chips. Well, our goal is to make sure that we always have chips.
He's got another one too. Don't bet your deli to win a pickle.
I'm not sure that I've ever heard that one, but I love it.
I might have paraphrased it. I'm pretty sure that's it. Hey, by the way, Larry is actually coming out with a book.
Oh, no way.
Yeah. I can't say much about it, but he's coming out with a book. Since you've mentioned his name, I had to give him the shout out. So
cool. Looking forward to it.
Let me dive a little bit deeper in terms of when I look at your track record and when I look at any good trend following track record, and I can see the numbers, but these numbers represent something. They represent the wins and losses spread out over your diversified portfolio, but they really just represent human behavior. right? I mean, it's really just, you're just capturing supply and demand. You're capturing greed and fear. And when I look at your track record, it's all embedded there. But people really have to imagine when they look at any particular month on your track record, that is, an aggregation of whatever was going on that particular month, whatever positions you were in. And those positions, back to the use of price, it's all about just capturing behavior of individual investor decisions on whether they're buying or selling. And you're just kind of following along.
Yeah. And that's part of the core philosophy. Essentially, every kind of strategy that we develop, we expect it to, and it has to work on a large basket of markets because we want to capture those persistent effects that are fundamental to how people work and to how people interact with markets. We're not really that interested in a niche sort of edge in, I don't know, in orange juice or whatever, just to pick a random market. We're interested in the kind of effects that are present across all markets and ideally at different times to give us that diversification that we're looking for. And one of them happens to be the long-term battle between supply and demand and how that plays out and manifests itself as trends.
As we wind down, what would you like to share? Kind of the open-ended question. What's been on your mind recently? What's discussed in the office? What do you see as novel in your world that I'm not so bright enough to ask, or I'm not so swift enough to ramble out of me? What really intrigues you these days about the space that you're in this trend following space, short and long term?
One of the things that's always excited me personally is maximum diversification. So one of the things that I'm always working on and that we're always looking into is expanding our reach, getting as many different markets into the portfolio as possible and really pushing the envelope to basically capture stuff that other people in the trend following world aren't capturing.
What's a good example of the last couple outliers that you've added?
One of them that we caught recently was lumber, and we're involved in the lumber space. And it's not a very liquid market, so it won't scale very well. But at the size that we're at now, it works great. And I'm sure that there's not a lot of other trend followers, particularly the big guys in that market at all. But the carbon futures had a great move this year, and we participated in that a little bit. And one of the things that we've done also is I think we're probably one of the few in the space who actually have the Bitcoin futures in the portfolio. We haven't traded them yet, but we're ready to go, at least on the long side for now. And we, generally speaking, tend to add markets very aggressively into the portfolio. We might not trade them as aggressively, but they're in there just in case something happens in these new spaces that people don't understand. But the exciting thing to me in that space is that sort of this explosion in computational power and, like, for lack of a better term, sort of the data science revolution allows us to start exploring the addition of hybrid markets and markets that we construct ourselves out of combinations of other markets and so on. So that's something that we're talking about a lot at the office and looking at getting into in a significant way is how do we construct our own markets, basically? How do we build unique return streams that other people don't necessarily have access to because there's something that we've created statistically? Obviously, a lot of research has to go into that, and there are reasons why you might not want to do that or why you have to be very careful about how you do that because you're maybe moving a little bit away from the pure raw supply and demand characteristics of a market like crude oil or something. But we're finding that there's still effects there. We haven't really started trading any of them yet, but there's still supply and demand type effects there, and that they might be a little bit more obscure and a little bit more difficult to access for many people.
I find it interesting you mentioned the Bitcoin, adding it to the portfolio, ready to take a long position. For those people that get trend following, they'll get why you just said that. But a lot of people might not get that. Well, the point is that Bitcoin has basically been hovering at about 6,000 for a significant period of time. And you want to see some upward mobility before you say we're going to take a position.
Yeah, exactly.
It's quite simple.
And it's building a really nice base right now. I'm just looking at the chart right now. It remains quite volatile. So our position will be very small if we do end up getting one. But who am I to say that Bitcoin couldn't be $100,000 this time next year? That's not a prediction. It could also just as easily be $50. But if it does one of those things, then that'd probably be a good thing for us.
And across all your markets, if any of the markets you're following, whether it's an up move or a down move, you're just as prepared.
Oh, yeah. And totally agnostic as to where it happens. I don't care. As long as it happens somewhere, we don't play favorites here.
Hey, that's a great stopping point for us. Paul, great conversation, great insights. Where can we send people? Where would you like them to go to check out more information, to reach out to you, contact, all that kind of fun stuff?
People can go to www.apollosrc.com to check out our website. And if people want to get in contact with me directly, they can probably figure out how to do that without me telling them.
ApollosRC.com.
Yep, that's right.
Hey, Paul, I appreciate you coming on. Thanks a lot, man.
Likewise. Thank you very much for your time and look forward to talking again soon.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.